Good morning, everyone, and good afternoon for those who are joining us online. I'm Tatiana Mosso with the IMF Communications Department, and I will be the moderator for this April 2026 Fiscal Monitor. And I'm pleased to welcome our panel today with Rodrigo Valdez, who is the director of the IMF Fiscal Affairs Department, Era Dablanoris, who is the deputy director of the IMF Fiscal Affairs Department, and Davide Fociri, who is the division chief in the Fiscal Affairs Department. Rodrigo, the floor is yours for opening remarks.
Good morning. Thank you, Tatiana, for the introduction, and thanks all for joining us today. Also, I want to thank today the Fiscal Affairs Department and COM teams for guiding me in this my first Fiscal Monitor presser. By the way, there is a picture here of the Fiscal Monitor. The other thing is that this is a tradition that Vitor Gaspar had in the department. You see the colors of ties and dresses here too. Okay, more seriously, the world economy is being tested again with the consequences of the war in the Middle East. And this is a world that has less degrees of freedom as public finances are more stretched in many, many countries. Let me share a few remarks at the outset. First, on the short run, and then on the longer challenges of the dynamics. So, understandably, there are abundant calls for fiscal support, given the pressures that households and firms are receiving from fuel and food prices increases. As countries respond, both focus and intensity matter. Our central advice: protect the most vulnerable while preserving the price signals to help economists adjust. And with debt already high in many places, a fiscal response must not put public finances at risk. Let me emphasize 3 points on this short-run response. First, unless things change in a big way, fiscal policy should steer clear of discretionary demand stimulus. It would make just harder the central bank job in terms of inflation control. Second, and here I want to put a couple of slides, broad-based energy subsidies or excise reductions are not the best tool. They distort price signals, are fiscally costly, regressive, and hard to unwind. Plus, as I will illustrate in a minute, they create international spillovers. Third, when support is needed, it should be temporary and targeted to the most vulnerable, and it should be consistent with the fiscal framework and debt sustainability of countries. In many places, expenditure reallocation is the viable alternative. Our view of what to do is summarized in this left table. And we are sometimes asked, okay, but what do you mean by targeted, temporary, etc.? Well, we think that the support should adapt to the severity of the shock, consider alternatives to reach to specific parts of the population, and recognize that energy and food shocks are different. Only if there are no viable alternatives, measures that weaken price signals should be considered. But they should not become outright price freezes. As I mentioned just before, international spillovers from controlling prices can be large. And let me give you one simple example. If the supply of oil is completely fixed in the short run, and half of the countries basically do not allow prices to move, the increase in prices at the global level will be twice as high. Basically because only half of the consumption has to do all the adjustment. Here, in the right-hand side chart of this slide, you have a bit more complicated example where the pass-through is incomplete. Only 10% is passed through in 50% of the countries. There's some assumptions about how is the supply and demand in the short run. And there is the case also for export bans. You have heard from the managing director, the World Bank president, talking about export controls also. That also produce effects on prices. In this example, you can see that if everybody passes through, there is one effect. If there are subsidies, export bans, etc., the price increase could be twice as much as the original one. That's what we mean by spillovers. Domestic policies affect global prices. The war could have very important fiscal consequences, but this should not overshadow the bigger and more persistent fiscal challenge that countries have. And let me now move to the more medium-run perspective and make 3 points about this. First, and these are very clear in the Fiscal Monitor, global dynamics remain unfavorable. And here I want just to show you the left-hand chart where debt continues to grow. Even though global growth was resilient in 2025, global fiscal conditions progressed very little at the world level. And it's not only 2025. The global fiscal gap, that is the difference between the primary balance that would stabilize debt ratios and the actual one, that gap worsened by 1 percentage point if we compare the 5 years we're living, and for that I mean 2024 to 2028, 2024 to 2029. And we compare that with the 5 years pre-COVID. So 5 years pre-COVID, we had certain situation. The situation of the 5 years we're living now is worse. This shift is explained in the middle chart, and perhaps here the most important thing is that this is not just a cyclical problem. It basically reflects policy choices, permanently higher spending, and lower revenues. On top of this, the world faces higher interest rates than in the past. If you compare this period of these 5 years with these 5 years pre-COVID, real interest rates are about 0.6% higher today, what countries are actually paying. As a result, public debt is projected to keep rising. In our WEO reference forecast, global debt reaches 99% by 2028, and this 100% mark before that we had in the previous editions. The second point I want to make is that risks are significant. Global debt at risk, that is a very technical way to look at debt that we define as the 95th percentile of projected debt distribution. So we're here thinking of not a point forecast, but a distribution of forecast. If we look at that, we see that at the 95th percentile, debt could reach 121% in 3 years' time, as is in the red line there, in the severe scenario of the WEO. So the black line is our reference scenario. That reference scenario has uncertainty. So the blue lines in the right-hand chart show the 50%, 75 percentile, and 95 percentile scenarios, basically. With the severe scenario of the WEO, this makes things tilted up and make things worse. Importantly, this is not only the war that is behind these scenarios. There are other risks behind, fragmentation, political instability, a potential large market repricing, for example, in AI stocks. Finally, in terms of risks, as central banks unwind QE and governments rely on more private investors, these private investors are more sensitive to market sentiment, and that makes movements in yields more volatile. Similarly, the duration of debt in the world has been shrinking, okay? And that implies that debt dynamics are more sensitive to short-run conditions. Let me finalize with the third point on this medium-term perspective, that is our advice. And this is very simple. Rebuild fiscal buffers once conditions stabilize, and do so without delay. Crises, of course, require emergency support and people focus in the crisis. But the ability to respond really depends on pre-existing fiscal space. And too often, the needed consolidation is postponed that only ratchets up, squeezing the fiscal space for the next crisis. Countries need tangible progress, anchoring credible medium-term fiscal frameworks and clear communication. The longer the delay, the steeper the effort will be in the future and the higher the possibility of not having an orderly fiscal consolidation. Finally, in low-income developing economies, a priority is to strengthen domestic revenue mobilization, to protect social and development spending, and also because we have to recognize that external aid is declining. With that, let me go back to you, Tatiana. Thank you.
Thank you, Rodrigo. So before we take your question, just a quick word on ground rules. So please raise your hand, introduce yourself and your media very quickly, and then we will get to you. We will start with global issues around the Fiscal Monitor, then regional. For any program-related, country-specific questions, please refer to the regional press briefing, which are going to start tomorrow. And with that, we will start with the lady in yellow, please. Fourth round.
Here we go.
Thank you so much. This is obviously a big theme throughout these meetings so far. We've heard this kind of mantra continuously from from the World Bank. I'm sorry, we've heard.
Please.
Andrea Shalal with Reuters. I'm so sorry, lady in yellow. We've heard this mantra throughout from both the heads of the IMF and the World Bank and other people, and now from you about the need to have these measures be targeted. But obviously the circumstances are so great. I mean, is there any possibility here of coming up with something that would be not a case-by-case thing, but a sort of, a reprieve? Is there discussion, should there be discussion about limiting, deferring debt payments because they're so high, just to give people a head start on this? Or is this crisis doesn't rise yet to the level of what happened during COVID? Thank you.
Rodrigo?
Okay, let me answer Andrea's question, lady in yellow. So, look, we have to differentiate very well the shock that we're living through and previous shocks. And this is a bit technical, but the difference is when demand is healthy or supply is healthy. If you try to undo a supply shock by trying to pop up demand, you will end up with more inflation. So we have to recognize that this is not COVID, not only because of the severity, which is very different, but also the configuration is different. That doesn't mean that this can morph to a different scenario if we have the severe case that is in the WIO and financial markets react. That could happen. But for now, this is, as Pierre Oliver said, a very much textbook case of a supply-side shock. And in that case, a strong fiscal reaction will produce more problems than benefits. Therefore, the need of big reactions is not there. That doesn't mean that everybody should care about the most vulnerable. Families are feeling this, but there are ways to do this that do not produce fiscal problems, because the scale is very different from what we were used to, for example, in COVID. Let me stop there.
Maybe just to add to that, and I think it's important to recognize that the starting point today is very different from COVID. Countries have much less fiscal space, room for maneuver. Debt levels are high in many parts of the world, and there are other imperatives on budgets as well. And so, figuring things out within a tighter budget envelope is important, and this is why our message has been pretty clear that it's really important to protect people, which is vulnerable people in particular, and not prices.
Thank you. We will move to, let's say, this side of the room, and then I will come back here. Lady in the first row.
Anisa Telesko, Serbian National Television. You said that broad-based price subsidies should be avoided. For energy importers, why it's considered a better option to let all prices free? How political authorities could be sure that higher inflation will not impose the greatest cost? I don't mean political. That's clear. I mean economic and fiscal cost.
Another global issue, I will go there and come back here. Sir?
Yes, Hugo Dixon at Reuters. You've talked about the importance of rebuilding fiscal buffers once the situation has stabilized. Have you given any thought to two particular things, given that we've been dealing with an energy shock? One is that you should do this through increasing carbon taxation. That would accelerate the switch to renewables. And secondly, have you given any thought to the use of windfall taxes on oil and gas profits?
Okay, thank you. And another one here, the lady in the first row, and I will let you take those questions.
Greetings. Olena Hrazdan, Kyiv Post. You talked about the fact that the subsidies hurt definitely, but judging from the preliminary data on the measures to combat the fuel price shock, do you have any preliminary data about the winners? You mentioned the targeted help for the vulnerable, but maybe you can give some more data about who is the winner in these policy dilemmas.
Sure. Let me start with a few things, and I will ask Era also to jump into this. Let me start from the inflation question. That's a mirage for the world economy. We cannot, with that policy, produce more oil. So although it could make sense from a perspective of a small country, if everybody does that, we're in big trouble. So that's why I think it's very important to reflect scarcities through prices, because we need to adjust to the reality. What are countries doing? And Era will give you more on this, but let me give you one piece of information where we have two efforts here, a tracking of policies and a monitor of prices. Let me just refer to the monitor of prices. Here, if you take the biggest economies, so about 17 economies in the world, it's interesting to see that 5 basically have zero pass-through. 7 have a significant pass-through, and 5 are intermediate. So the experience is very heterogeneous across countries. If you look at regions now, and not the bigger economies, and I can see that in the Middle East, there is less pass-through. Then in Sub-Saharan Africa is the second one. In Europe and emerging markets, the pass-through is the biggest. All countries, or almost all countries, are passing through. So again, the experience is very heterogeneous. And what is very clear is that exporters of oil tend to contain more prices than importers of oil. Okay, before going to Era, one issue about transition, energy security, the aspects that are very important. Let me make 2 points here. One is that there are many tools to help accelerate this transition. You mentioned carbon taxes, there are others too. This shock will produce incentives to do it. So that doesn't need to be a restriction for fiscal. Now, I would say that the magnitudes are such that these tools will solve the fiscal. Okay, the fiscal problem is sufficiently high that it's not only one tool that will solve it. We really need to look at more revenues and also, for sure, containing expenditures. Final point on the energy issue is that, although it's very important, during a period as the one we're living through, that is basically scarcity, we should not confound security with hoarding. Hoarding in this moment is not good for global prices. And that is also something that our authorities of the bank and the fund already mentioned. Thank you.
Yeah, maybe just very quickly to add to what Rodrigo was saying. So we're actually tracking what countries are doing around the world. And we're doing this in a very comprehensive way. We're looking at the types of measures that countries have put in place. And what we see is that countries are really adopting a wide range of measures. So some are adopting revenue-based measures, so a cut in VAT or excises. Others are doing spending-based measures, and yet others are doing pricing measures. While it's too early to determine what the fiscal cost of these measures are, what is becoming clear is that the response so far has been much more restrained than, say, the 2022 shock, the energy price shock. And part of it is because it's not entirely clear. There's a lot of uncertainty as to how long the situation will last. So countries are not necessarily coming out in full force with huge packages. That said, we have some important lessons that we learned from the 2022 energy shock and other shocks similar to that. And that is that while these broader energy subsidies and price caps can cushion households, this is not to say that they don't work. They do work. The fiscal costs associated with them can be extremely high. So in an environment, as we mentioned, where fiscal space is much more constrained and governments are facing many different trade-offs, not just in the near term, but also over the medium term, choosing a sort of a more disciplined way of cushioning the impact is what we're advocating.
Thank you, Ira. Another set of questions. So I will go here, and then we will go with the gentleman there, and we will go back there. Thank you.
Kirill Krasnikov, RIA Novosti. Tell me, at what point does a prolonged closure of the Strait of Hormuz stops being a temporary external shock and would require some structural fiscal adjustments rather than targeted measures?
Thank you. The gentleman there.
Thank you very much. Paul Blake from AFP. You talked about the need to rebuild fiscal buffers once conditions stabilize and to do so without delay. Many countries, the electorate, there's no political will for belt tightening and social discontent is high. How are you all thinking about that and how are you advising member countries?
Thank you. And this side, the gentleman there, please.
Thank you very much. I'm Mr. Ben Saidia, the correspondent of the private TV in Senegal. Does the IMF Spring meeting 2026 Fiscal Monitor sufficiently reflect the uncertainty created by recent cases of fiscal misreporting and concealed liabilities in several African countries? And how confident can policymakers be that its recommended fiscal frameworks generally bolster economic sovereignty rather than deepen external dependence in environments where data integrity itself is in question? Thank you.
Thank you.
Okay, so let me start from the last question, and then I will pass to my colleagues, the others. Let me say that in terms of misreporting, let me first say that we commend the Senegalese authorities for their commitment for transparency and for disclosing this unreported public debt that happened before. In terms of the Fiscal Monitor, I can say that we always use the best information that we have available, and that is practiced at the fund level. And in terms of misreporting more broadly, as you know, we are conducting an internal review. We'll have to go to the board with some of the conclusions at some point. But it's very important that we are already working on some aspects. No? We are revising the data integrity frameworks that we have. We're strengthening our review internal process, and fiscal affairs has a very important role there. No? We have experts on this. And also enhancing the internal training to staff for better identify misreporting cases. There are techniques within our review process where we can check consistency, and that has to be deployed to the full extent to try to minimize these cases. Now, misreporting have existed for a long, long time in different cases. Sometimes it's just capacity in terms of countries. So, but we need to minimize them, of course. Thank you.
Thank you.
So maybe just very quickly on the political economy, and I'll turn it over to my colleague, Davide. So our research also shows that political discourse has become more expansionary around the world, not just in advanced economies. And the calls for restraint or fiscal restraint have actually declined over time. And this is true for political parties of all stripes across all types of countries. Now, that said, we also have shown in previous monitors that countries have undertaken complex, difficult, challenging reforms in different contexts. So what matters? Transparency, the ability to spend smarter, something that we've highlighted time and time again. So spending efficiency, improving the efficiency of the way the manner in which you tax, communicating trade-offs to the public in a very clear way so that people know, everyone's on board, and in the process of reform, ensuring that you protect the most vulnerable, who often lose from these reforms. So there is no magic bullet, if you will, but there are lessons that we've learned from previous experiences of reforms.
Yes, let me add about one aspect of reform that is actually quite relevant right now. Many countries, as Rodrigo era mentioned, they have in place large subsidies. So these subsidies, we know that are regressive, they are fiscal costly, and they are distortive. What our research has shown in the past Fiscal Monitor is that countries can successfully manage to move from generalized subsidies to more targeted transfers. And this basically has impinged on three sort of arrows. The first arrow is clear communication and strategy, engage with the relevant stakeholder to make sure to get buy-in for the various reform, split what are the trade-offs. The second was accompanying reform, especially on governance, policies that tends to foster trust towards the government to make sure that any windfalls in revenue is spent on things that matter for the societies, for development. And third is the designs of the reform, in terms of timing, but also in terms of graduality of the reform.
Thank you. We will go online as we have some questions. I think we have Doha and from Egypt, and I think Gianluca from Il Sole. Can you hear us, Doha?
Good morning, Tatiana.
Please go ahead with your question.
Thank you so much for taking my questions. Actually, I have two questions. My first question is on the ongoing war in the Middle East. To what extent this ongoing conflict and the related escalation could reshape the spending plan for the region? My second question is specific on Egypt. Could you please, Rodrigo, brief us on the projections for the country's debt, current account deficit, and give us a snapshot on these projections, and also to what extent Egypt could maintain its fiscal consolidation plan amid the repercussions of the ongoing war. Thank you so much.
Thank you.
Let me give you a quick overview regarding the MENA region. So we currently have a public debt that is projected to increase to reach about 54% of GDP by the end of our forecast horizon, which is a level that has been higher than pre-COVID. Now, the fiscal impact is likely to be very heterogeneous, both between oil exporter and oil importer, but also within oil exporters. For oil exporters, the fiscal drag will ultimately depend on two factors. One is the price. The increasing price, of course, is going to help the fiscal buffer. But on the other side, we have a cut in production and export that is going to dampen the fiscal revenue. So the net effect will really depend on the strengths of these two channels. So you have some countries such as Oman, for which we have increasing fiscal space, and some countries as Iran, for which this is decline. For oil importer, typically the effects are negative, stemming from lower demand, coming from consumption, coming from lower activities. But also, as Rodrigo mentioned, if you look on the spending side, typically the pass-through in this region has been relatively small because many of these countries have subsidies. So this is going to add to the fiscal cost.
And maybe just very quickly on Egypt. So just to say that in Egypt, as you know, public debt remains elevated. It's around high 80s as a percent of GDP, and financing needs they remain large, although debt is projected to decline over the medium term. So given this high level of debt, maintaining fiscal discipline becomes very important. And the higher energy prices do add to fiscal pressures. As an energy importer, Egypt is now facing higher fuel and import costs and tighter global financial conditions. And this increases debt risks in a high debt environment. But so far, the economic impact of the war has been contained, and it's been supported by decisive and coordinated action that the government has taken. But that said, I think the bottom line still is that sustained fiscal reforms remain critical, given high levels of indebtedness, and stronger debt management, reducing the footprint of the state, mobilizing revenues in an efficient way. All of those recommendations continue to hold.
Thank you. So we will stay with regional and questions. Sir, on the first row here.
Thank you so much. Igor Nemushin, RIA News Agency, DC Bureau. Question to Mr. Valdez. So it's about the U.S. debt. According to the IMF projections, the U.S. debt will exceed 142 by 2031. This year, over 125% of GDP. So does the IMF believe that the U.S. economy, in terms of debt, of course, is too big to fail, or the debt distress is inevitable if the U.S. government just continues to, kick the can down the road and there's no clear path for debt consolidation? Thanks.
Do we have other U.S. questions, please? The lady here.
Hi, thank you. Sabrina Escobar with Barron's. I do have a follow-up to that. Chiefly with the role of treasuries, there seems to be a move away from treasuries as a go-to safe haven asset. And I think you mentioned in your report how there's a disappearance of the premium treasuries used to command. So I'm wondering what that disappearance means for the cost of capital for corporations and even other markets, including emerging markets that use it for or rely on treasuries for external financing. Thank you.
Last one, a U.S. question too, please.
Hugo Dixon at Reuters, you've talked about the danger of countries engaging in export controls and subsidizing oil consumption in terms of the spillover effect. Have you done any analysis of what it would mean if the United States adopted those policies?
Thank you. Rodrigo?
Okay, so on the U.S. in general first, the deficit in the U.S. dropped from close to 8% last year, general government calendar year. The translation between fiscal, central government, federal government, and fiscal year is not trivial, but let's talk with numbers comparable to the rest of the world, that is calendar year and general government. And the deficit moved from almost 8 to slightly below 7. So it was a good year in terms of some consolidation, explained quite a bit by tariffs. But our forecast is that this deficit goes back to around 7.5% and stays there for the near future. That means that the dynamics of debt continues to go up, as you mentioned before. What we have said is that the U.S. needs a credible, and I would add robust, consolidation plan to put the ratio of debt to GDP in a downward path. That means that the adjustment should be around 4 percentage points of GDP, which is not minor, of course. How to do that? This was extensively discussed in the Article 4. The Article 4 with the U.S. Happened just a few weeks back. So you can refer to that, but there are many of things both in spending and revenues. It's important that markets today give the U.S. space, but the fact that the duration of debt is lower, that we have these holders of debt that I would say are less firm, this cannot wait forever. there is time, but we cannot wait forever. And Congress has to accompany the government in this effort. In terms of this premium that exists in the US debt market, that premium was tested these days. And it's very interesting that against emerging markets, the premium remained. Okay? With the other big advanced economies, however, the US behave more similarly. So these are signs that markets are, I would say, not as sanguine forgiving than they were in the past. No? But again, there is time because markets are behaving well. At the same time, the more time passes, the more pressure you could be down the road. So it's very important to deliver on this.
We have less than 10 minutes to go. I go back to the lady on the first row here, and then we will come back to here to the center, and we will end there too.
Thank you very much for taking my question. I'm Nancy Naji, African Independent Television from Nigeria. My questions are two questions. First on Africa. How vulnerable is Africa fiscally speaking, bearing in mind that majority or some of the countries have elevated debt, as well as they are all producing countries like Nigeria and Angola. Then the second question is on Nigeria. Nigeria, at least in the last 2 or 3 years, have undertaken reforms. Do you think that the external pressures we're seeing now, how resilient would those reforms be, this Middle East crisis? How much test would it be for those reforms? Thank you.
Thank you very much. We will move quickly here on the first row with the lady here.
Thank you very much. Karishma from Business Today, India Today Group. The Fiscal Monitor report also speaks about India's debt-to-GDP ratio currently elevated at 84% as per the latest. If the country continues to cushion its consumers, how will it manage fiscal management and also protect its consumers?
Thank you. Here on the first row, and then we will go there.
Thank you, Tatiana, for taking my question. I'm Maolin Shong with Xinhua News Agency. I want to follow up on your remark about energy transition. You talk about that we also need to contain fiscal spending and try to increase revenue. But for some countries, if you want to transition toward more renewable energy, they might need more upfront fiscal spending and investment, which could be challenging. And I was wondering, how do you view that balancing act in their fiscal policy, like the short-term costs and the long-term benefits? Thank you.
Thank you. And the gentleman there to close.
Jeremy Warner from the Daily Telegraph. Sorry, please. Thank you. Jeremy Warner from the Daily Telegraph. I see from the projections at the back of the Fiscal Monitor that you have the UK tax burden rising by more over the forecast period than almost any other country in the world. Do you think that there is some danger, and obviously that is one path to rebuilding fiscal buffers, but do you think there is a danger of that undermining growth in the UK, and can more be done on the spending side of the ledger, particularly sort of out of control welfare spending? And you also mentioned the premium that the US now has to pay for borrowing. That's also the case in the UK, so perhaps you could comment on some of the reasons for that.
Thank you. So, Ira, Rodrigo, and Davide, you have less than 6 minutes.
Okay, let me start with Africa. So many low-income countries, including in Africa, are probably those that are more affected by the current shock. Why this is the case? Because we have seen not only energy price going up, we have seen fertilizer price going up, we are seeing increasing shipping costs. And these all the increasing different type of prices, so they are going to reduce output, production, but also consumption. And in some countries that are more vulnerable, there is the risk that is going to affect poverty and food security. So the fiscal pressure stemming from all these costs are likely to be relevant. However, again, there is a differentiation between oil exporter countries, such as, for example, Nigeria or other countries, for which the oil price is going to generate some windfall, And in those cases, it's important that these countries use this windfall in revenue to clear as arrear, build the fiscal buffer, and reduce interest payment. In the case of Nigeria, as well as other countries that have implemented the subsidy reform, implies that the fiscal cost from increasing energy prices is going to be lower. However, for many countries, there is still need to build buffers, and in many countries, revenue mobilization is a priority given that interest rate to revenue stay quite high, about 15% for many low-income countries.
Thank you. Next question, Rodrigo.
Okay, let me go to the question on energy transition, India and the UK. On India first. First, strong growth makes life much easier. Each country would be in a better position if they were growing as India is growing. And India is not a cyclical phenomenon. Its trend growth is much higher. Second thing, we think that the fiscal targets are within reach. However, there are some risks from the subsidies to fertilizers and fuel prices. And as in other countries, we will recommend to try to find space to reallocate. Importantly, in the medium run, India should sustain the efforts to lower its debt to GDP ratio to open space for other emergency spending. In terms of the UK, let me just say two things. One is that it depends a lot of what you do with the money you collect for the growth impact of revenues. And the assessment of the UK team, although this will continue in the next few weeks because Article 4 is starting, so we should not preempt that discussion. However, what I can say is that the team assesses that the combination of the package is good because it's dealing with the fiscal, but a good part of the spending is also helping growth. On debt and yields, well, we're living a period where yields are becoming more sensitive to that. And that is a bit of the canary in the mine, no? That is telling you, look, we're getting closer to where things may need to be rushed in terms of adjustment. On energy transition, I will just want to say that this event that we're living through is a short-run problem that will not be solved by policies that take time, okay? So we should not confuse the two discussions. But energy transition and energy security are important. They have this fiscal aspect in certain cases. However, as I mentioned before, you can charge, and let me give you two examples. You can charge for security, and also you can charge for the externalities that many of the fossil fuels produce. There is every 2 years a report by FID trying to put numbers on this. And the numbers are very large. So I think there is no reason to think that there is a contradiction between fiscal rectitude and transition.
Thank you. We had one last online very quickly. Could rapid adoption of AI improve fiscal outcomes or widen inequalities and budget pressures? Ira, very quickly, and before we wrap up.
AI person in the department.
Let me just say that AI presents major opportunities for governments. It can raise productivity, improve the way governments do their business, so think more efficient tax administrations, better service delivery, better use of data for improved health, education, social protection systems. So that's the good side of things. It can be used to fundamentally reshape the way governments do their business. But at the same time, I think it's important to recognize that there are risks. It can reshape jobs, and this is a risk. It can concentrate returns, wealth. It can increase inequality, and social protection systems may come under pressure as jobs are impacted. So I think the fundamental question that governments need to ask is that are our current tax systems, are our current social protection systems fit for purpose? Because there's a lot of uncertainty in the way AI will play out, what actual impact it will have on labor markets, what actual impact it will have on inequality. So the challenge for government is really to see whether their systems are adaptable and that they can meet the risks that it portends.
Thank you very much, Ira. Thank you, Rodrigo, Ira, and Davide. Thank you all for joining us. The full report, charts, and background materials are available on imf.org, and the communications team remains available, of course, for any follow-up question. Please stay tuned, or please stay already in this room, as the press briefing with the IMF Director, Mrs. Kristalina Georgieva, will start very soon. Thank you very much.